In addition to vertical and horizontal analysis of financial statements, managers, creditors, and investors also study comparisons among various components in the statements. These comparisons are expressed as ratios and are known as financial ratios. Liquidity ratios tell how well a company can pay off its short-term debts and meet unexpected needs for cash. A ratio is a comparison of one amount to another. A financial ratio is simply a ratio whose numerator and denominator are financial information taken from the balance sheet, the income statement, or other important business data. Businesses must have enough cash on hand to pay their bills that are currently due. The liquidity ratios examine the relationship between a firm's current assets and its maturing obligations. The amount of a firm's working capital and these ratios are good indicators of a firm's ability to pay its bills over the next few months. Short-term creditors pay particular attention to these figures. The term working capital refers to the difference between current assets and current liabilities at a point in time, where working capital equals current assets minus current liabilities. Theoretically, it's the amount of money that would be left over if all current liabilities were paid off by current assets. Current ratio or working capital ratio is the comparison of a firm's current assets to current liabilities, so current ratio equals current assets over current liabilities. This ratio indicates the amount of current assets available to pay off $1 of current debt. The current ratio of 2 to 1 or greater is considered by banks and other lending institutions to be an acceptable ratio. Finally, the acid test or quick ratio indicates a firm's ability to quickly liquidate assets to pay off current debt. So quick assets equal cash plus marketable securities plus receivables. So our acid test ratio equals the quick ratio over current liabilities. This ratio recognizes that a firm's inventories are one of the least liquid current assets. Merchandise inventories and prepaid expenses are not part of quick assets because they're not readily convertible to cash. An acid test ratio of 1 to 1 or greater is considered acceptable.